I put these on this morning, and I said, actually, when you're 70 years old, you need things. You need props. You need even guys need a little makeup and stuff. And so I put these on as I was getting dressed, and I said, "Man, that's a pretty cool-looking dude." I said, "I need at least one moment to see myself on the big screen." So there I sort of am. I can't see my notes. And I'm not really Hollywood, so but there you go. I'm 70 and moving on, as I say. Well, thanks for having me. Thanks for being here. Boy, it's impressive from this vantage point. A lot of people and a lot of listeners. I appreciate the chance to talk to you about a few things about investing and about. Movies, which I'll mention in just a second, and thank you, Don, for the kind introduction. I wasn't really sure what Don would say about me. According to the recent buzz, it could have been something about General George Patton, maybe berating a wounded soldier, or a Wall Street version of Justin Bieber, or maybe just a Kim Kardashian impersonator if you wanted to hear about my feminine side, which I'm sure you don't. In any case, if you really wanted to know about me, just ask Eric Jacobson here at the front table, because I've told him 100 times over the last few months exactly what a great guy I am, and he should be able to tell you as well. It should have sunk in by now. And it sort of reminds me of a movie, this is the movie, but called The Manchurian Candidate. And there have been two, most recently with Denzel Washington, but the first one with Frank Sinatra and Lawrence Harvey. You guys are too young to probably remember this movie, but it was a movie about hypnotizing American soldiers in North Korea during the Korean War. And so the North Koreans captured 8 American soldiers and hypnotized them into repeating to the public when they got home to America that their autocratic Captain Shaw, as he was called, that was Lawrence Harvey, was the kindest, warmest, most wonderful human being they'd ever known in their life. And they would repeat that for hours and hours when they went back to the American public. And because of this, the public eventually grew to love Captain Shaw. Someone whose image resembled, I guess, like the future Ronald Reagan, or somebody similar, I guess. A real nice guy. And Captain Shaw eventually ran for the vice presidency, and things went on. You don't need to know the rest of the story. You probably know what happened. But I remember The Manchurian Candidate, and we're talking about image here, and who am I, and who do you think I am? And so as a goodwill gesture, I thought that I'd invite reporters from the Wall Street Journal and from Bloomberg and the Financial Times and the New York Times and Reuters, and not to leave any of you out, but I'd invite you to a Newport Beach round of Texas Hold'em, and we'll flop the cards, and hopefully there'll be a pair of red queens on the flop, just like there was with the Manchurian Candidate, and I'll say to the reporters, repeat after me. Bill Gross is the kindest, bravest, warmest, most wonderful human being you've ever met in your life. Hopefully that'll work. Maybe not. But I thought, to be fair, I should take, and I've already taken some self-help courses in hypnotism, and I've trained myself. So that when I see a red queen, just like they did in the Manchurian Candidate, and when I play solitaire, I repeat the same phrase but with a twist. And I say, reporters are the kindest, bravest, warmest, most wonderful human beings I've ever met in my life. And so playing cards, it seems, can be great therapy, and I've never been happier at work. We have a new deputy CIO structure with 6 of them that's working fabulously. We've got a new CEO and president, Doug Hodge and Jay Jacobs, exceeding expectations. And we just moved into a new building 3 weeks ago. And if there's a happier kingdom on earth, it may be 15 miles up the Santa Monica Freeway at Disneyland, but that's a fantasy. And I'm talking real time here. We're having a good time, and we're a happy kingdom at Newport Beach. Okay, let me move on. And for those of you that would like to have a memento of those Red Queens, I've got a surprise in my pocket. Perhaps some of you after the speech can come up, and I'll give you one of them. But let me now move to more critical investment-related topics, not cards. And I want to approach, yes, this is my time to sort of commercialize, so bear with me. But I think hopefully I can give you a sense of who we are and what makes sense in the investment markets and what has made sense for the past 20, 30, or 40 years. So I hope there's some information to be gleaned from this, and so you just won't think I'm doing PIMCO bragging. But let me start out and talk about the total return fund and why I think it's been successful over such a long time, because that really speaks to PIMCO. And to me, the total return fund has been a Mercedes, not a Model T. It's not a Cadillac. It's a Mercedes. You ride in comfort, and you ride with style, and you ride with the expectation that you'll get to your destination in the future. And maybe even the total return in the future, we like to think of it as a new Google car, I guess, in which, yes, you still got to drive it, you still got to actively manage it, but it'll be well engineered, it'll be safe, it'll give you exactly what you want. The total return fund will never be a compact car, or hasn't been for the last 20 years for sure. It's $230 billion and was, as we know, $280 billion just a short 12 months ago. It's the world's largest bond mutual fund, and maybe depending upon where the Vanguard Equity Index is, maybe the biggest. But it's a big one. So it's not a compact car. But it does what a customer wants it to do, and that's to outperform with less risk on a consistent basis. And so let me try and give you an explanation as to why. And this is where I hope you won't think I'm journalizing, and where some of the information that I'm going to give it can be very useful going forward. In effect, I think I'll be handing you the keys to the PIMCO Mercedes, or the PIMCO Google car of the future, or even the PIMCO Happy Kingdom that I just described a few minutes ago. So at PIMCO, I and others at PIMCO have long been a believer in investment structures or templates. I'm sure Morningstar views that as a critical and an important element in managing money. For us, it's critical. A template is critical, and I've seen them, and you've seen them too, work for brilliant investors. There's Ray Dalio and Bob Prince at Bridgewater, just really smart people. Whenever I read something that they print, I'm totally flabbergasted and have to take it home and read it over and over and over again. Just brilliant people. But Dalio's got a template. He's got a long-term view of how economies work and how investment markets fit into that puzzle. And sometimes it doesn't work for them, but usually it does. But it's the structural template that I think that's important for them. GMO, Jeremy Grantham, they have a template. It's a different template. It basically speaks to mean reversion, and Dahlia's does to a certain extent, but it's not the same. But it's a template. It's a structure that they follow. And of course, Warren Buffett at Berkshire has a template. A safe and secure, basically closed-end fund that can't be disrupted by financial flows going forward. There are lots of others too, but I think it's important to have a structural template. And at PIMCO, we've got a template, and the foundation has always been based on three structural elements. And this is where I might be giving away the keys, but I think it's pretty well known. But consider. At least, how it might work for you or for your company that you represent. We've got, first of all, a world-class bottoms-up credit analysis team that I think every successful stock and bond manager must have, and so that's the fundamental necessary element. But in addition. Our structural template is as follows, and it comes in three parts. First of all, we do what we call Bonds Plus. We sell a product called Stocks Plus, but Bonds Plus, basically is the strategy, and it was the first. And actually, this is one of the things I'm most proud of. I had no idea in the 1980s. Chris Dialynis had joined us from the University of Chicago, and we were in touch with Myron Scholes and so on. But we devised this concept that Peter Bernstein, the late Peter Bernstein, and Peter should know because he knew about capital market structures and wrote two great books about it. But we devised a product called Bonds Plus where you would join interest rate futures and as ultimately as swaps came into the market, vehicles that didn't require very much cash. But we would join that, Bonds Plus, with short-term 6 to 12-month corporate notes and floating rate notes. In effect, we turned our treasuries into corporate bonds. And that's why it's a little misleading when not to keep harping on the press, but the total return fund monthly numbers come out, and PIMCO increases treasuries or PIMCO decreases treasuries. Actually, our treasuries aren't treasuries; they're corporate bonds in disguise. And one of the reasons that we've been so successful is that it adds about 30 or 40 basis points a year with relatively little volatility, surrounding it. It's not your typical corporate product with a 5-year maturity or a 7-year maturity where spreads can make a difference. It just sort of trickles down in terms of mist as opposed to heavy rain. So that's the first structural element. The second has been an emphasis on intermediate maturities and rolling down a positive yield curve. Not a great strategy in the first 5 months of this year, and one of the ways that a strategy like this can come back and bite you. But historical studies have shown, there's a great book by 3 British authors called Triumph of the Optimists. If you ever have a long weekend or have nothing to do, which of course we always have something to do now, but you can get into this book like I did with the Bible when I was a kid. You could just read and read it and go over it and go over it. There's so much information in Triumph of the Optimist that it's an education in and of itself. Anyway, there's that book. There's Ibbotson and Sinkfeld. There's lots of studies on a 100-year history of maturities and how they perform. And what they show is that over a long period of time that a 5-year treasury or a 5-year gilt, basically has equaled the performance of a 30-year treasury or a 30-year gilt, and we're talking 100 years here, and right away, you must wonder, well, how how can a 5-year that yields 100 or 150 basis points less than a 30-year equal the performance of a long-term treasury bond or a long-term gilt? You must be making a durational play in which interest rates went up and the 5-year did better because it has less duration. Well, not so. The reason that it outperforms basically is that it rolls down a curve, a positive yield curve, which is the essence of capitalism. And the 5-year becomes a 4-year. You get a capital gain. It adds to the total return and it equals over a long period of time, the 30-year return. Now, there's a lot of noise in a 5-year treasury. We saw that yesterday. We're seeing that today. We saw that this year. We see it all of the time in which curves are in motion. There's a lot of noise there in the 5-year, in the belly of the curve. But PIMCO thrives on noise, and that's basically what I'm saying. It's our second structural element. The secret there is patience, just like with Dalio and with GMO, in terms of reversion to the mean and those types of things. You don't want to overemphasize it when the curve is flattening, but a 5-year versus a 30-year on a long-term basis with a lot less volatility is a great structural bet in a structural template. And third of all, in terms of our templates, we employ volatility sales. Sounds dangerous, is sometimes. Not necessarily involving derivatives. I mean, we use 30-year mortgages, of course, and they have lots of volatility embedded within them. That's why they yield 60, 70, 80, 100 basis points or more than treasuries, inherent volatility with prepayments. So selling volatility by owning a mortgage isn't necessarily something super risky, but PIMCO as well sells volatility these days at respectable tails, I guess, of the marketplace and collects premiums. And when markets are volatile, then PIMCO doesn't do so well. That's 2011 and that's 2013 with the taper tantrum. But otherwise, it's a good business. It's what Buffett does. Buffett, in addition to being a brilliant investor, has an inherent insurance company where he underwrites risk. And hopefully, they make underwriting profits. A lot of the times they don't, and they just use the cash flow to make money with riskier assets. But in any case, selling insurance is a viable business for fire, flood, automobiles, and so on. And people are willing to pay for that. And you would say, well, why would they be willing to pay for that? Well, why are people willing to pay for insurance? They want to sleep at night. And so at PIMCO, we're willing to sell that insurance. We're willing to sleep less, I guess, which is the follow-on element to it all. We're willing to sleep less, but perform better. Obviously, the volatility has to be underwritten properly and priced appropriately. It doesn't pay to write insurance, flood insurance, before a flood. But over time, it's been a very respectable structural template alpha generator. And so those are the three PIMCO structural tilts that add about 75 basis points of structural alpha per year. And it's not hard to win a race if you start with a 75-yard lead. Depends on the length of the race, I guess, and depends on the horses in the race. And I guess, like in the last 5 years, if they're high-yield horses, it doesn't necessarily work too well on a comparative basis. But over time, the total return fund can and has competed with those high-yield horses with a lot less volatility because of this structural template. And many of you would be amazed because we don't see that in the press at the moment. But as of this very day, as of June, is it the 18th or the 19th? Audience participation? 19th, all right. As of June 19th, the total return fund, long lambasted as underperforming, is outperforming its index by a decent margin, before fees, but outperforming its index. And yet, to complain into wine, we're $50 billion poorer over the last 13 months. It makes you wonder why that would be. And perhaps we haven't been using enough red queens, I guess. In any case, this is the end of the PIMCO commercial, which I thought would be helpful to all of you, maybe in your own experience. I actually hope you haven't been listening, but I thought at least that you deserve to know because you're here, and that says something. In the minutes that follow, however, let me focus on the markets, on value and timing and decisions that make headlines, and a good portion of additional alpha for good and excellent investment managers, whether they be in bond stocks or any other asset category. And today the focus, and yesterday the focus was and is on central banks and their policies, and what we at PIMCO call the new neutral. The new neutral. And we thought we were usurped by Bloomberg on this because they had a report about 2 months ago, and it was headlined with the new neutral. But a Bloomberg reporter this morning was gracious enough to say, no, you actually thought it up. An Australian team, PIMCO team, first introduced new neutral. So this one's ours, baby, for better or for worse, I guess. Sort of like the new normal. It's nice to have something to be known by as long as it works. The new normal worked pretty well and has. We've had a 2% economy for 5 years now, and that's certainly a new normal. What PIMCO didn't do, to be fair and honest, was to translate the new normal into the fact that stocks might double and that monetization might flow into financial assets as opposed to the slower real economy. So we sort of missed the most important part, but we got the new normal. And hopefully we've got the new neutral, which I think is a critical idea, thought piece for all of you as investors, and certainly for central bankers around the world. We would say, to mimic the movie again, that the new neutral is simply the biggest, the most critical, the most significant, the most important element in asset pricing today or in the past. The problem being that we have very few red queens to convince you that that's the case. The policy rate, though, along with forward expectations and volatility, corporate and equity risk premiums, has always provided the fundamental foundation for asset prices. It is the foundation, the short-term rate and the expectation for it going forward. And that leads to prices for 10-year treasuries and 30-year treasuries and stocks and PEs and risk premiums and all of that. And it all starts with the policy rate. And so if you can get the policy rate right, if you can formulate a structural template around the new neutral and get it right, then you got some money in the bank for your clients. But the new neutral policy rate in real and certainly nominal terms changes over time, and that's the problem. The idea of a neutral policy rate was created by a gentleman by the name of Irving Fisher in the 1930s. And Fisher went on to become famous by speaking to a permanently higher plateau of stock prices. You've all seen that. And so people remember him mostly by that. Too bad. Because he was the guy that came up with the idea that there was a neutral policy rate. In other words, he thought the real rate would be constant. He thought inflation would go up and down, and policies and Fed funds would change because of it. But he thought real rates would be relatively constant. It's there where history proved him wrong. Fisher was wrong. The real rate is not constant. And that's the critical element to this new neutral that we've got going. In the nearly 80 years since his original theory was introduced in the 30s, real policy rates have fluctuated between 0 and 8% during periods of positive inflation. And importantly, and here's the critical thing, you may not care about the policy rate, and hopefully you don't leave here thinking, how do I understand all this? The critical link is that bonds and stock prices over this 80-year period of time have been critically influenced by what the real policy rate was. I mean, do you wonder why stocks in 1981 sold at PEs of 6 to 7 times? And you could say there was a recession and corporate profits weren't doing very well. But it was really because Fed funds, nominal funds, were trading at 20% thanks to Paul Volcker, and real Fed funds, we've got to distinguish now between nominal and real. I don't want to get confusing here, but it's the real policy rate that's important. In 1981, the real policy rate was 7 to 8%. And so equity risk premiums, in order to match that 7 to 8%, had to go up substantially, and therefore PEs, price earnings ratios, had to go down substantially. And so we had PEs of 6 to 7 times with a real policy rate at 7 to 8%. It was critical for stocks. And if you'd only known what Volcker was going to do, go to 20% in terms of nominal, go to 8% in terms of real, you obviously could make a fortune by not owning stocks or not owning bonds. It was the same thing with long-term treasuries, 30-year treasuries, 15% nominally. Why? Of course there was inflation, but the real interest rate, the forward interest rate, which investors didn't expect to continue at 7 to 8%, but the forward curve was high in real space. And so long-term treasuries traded at 15%. And it set the foundation for the 30-year bull market that bond investors have experienced, and the 30-year plus bull market that equity investors have experienced. Over the next 30 years, since 1981, that policy rate, that real policy rate came down, 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 and finally, in the past few years, real Fed funds have been negative. Negative. We have a 25 basis point Fed funds rate. We've got 1.5% plus or minus inflation. We've got a negative 1.25% real policy rate at the moment. So it's been a long journey from 7 to 8 real to a minus 1.25, 1.5. So the point here is that the real policy rate changes. It changes. Fisher was wrong. And as Janet Yellen recently agreed, not yesterday, but agreed in prior speeches, she's agreed that, there is an evolving policy rate, not only nominally, but real. She called it, and she did. It sounds, Janet Yellen is a very academic, measured, well-informed, careful, except for 6 months, careful person, but she described the real interest rate in Goldilocks terms. She said what they were trying to do was find something that was not too hot, not too cold, just right. And the just right policy rate, whatever it is, the new neutral, was going to be the rate that would produce 2% inflation and hopefully 3% growth, although they would take 2.5 or maybe 2. So something like 4 to 5% nominal GDP was their target and is their target for this new neutral rate, whatever it's going to be. And I might add third, and critically, people tend to forget this. The Fed really has a third charge these days, and that's financial conditions. The problem of Lehman in 2008, the papers of Jeremy Stein 2 years ago have all informed them that financial conditions matter. And so while she may dismiss to a certain extent in press conferences the the current level of financial conditions, there's no doubt that there's three targets that the Fed has these days, and that's growth / unemployment, inflation, and financial conditions. That's what the new neutral hopefully will perfect going forward. Okay, so what is this real policy rate? And is it really different and changing and newer than what we've seen over the past 25 years, or is it just something PIMCO thought would be cool to follow the new normal and to solicit interest? Well, it's not. It is changing. The Fed acknowledged as much yesterday when they changed the green dots, the blue dots, the dots. In terms of their forward expectations, they brought down the nominal policy rate and the real policy rate, in effect, by 25 basis points, and it's going lower and lower and lower. So it is important to try and find out where it's going, because it'll influence stock prices and high yield prices and spreads and all of that in consideration. One thing that PIMCO thinks it knows, one thing that the Fed thinks it knows, is that the real new neutral is not minus 1.25%, which is where we are now. Although to be fair and to stimulate discussion perhaps, the 1.25% negative policy rate, real policy rate, over the past 5 years has not even allowed the U.S. economy to reach the goals of 5% nominal GDP. We've been stuck in a new normal world of 4 to 3.5% nominal GDP, and so a negative rate for a long period of time hasn't really done much. The problem is that what it has done is stimulate investment markets, and that's where the financial conditions come in. That's the real reason, we think, why the Fed at some point will move and try and move the real interest rate higher from 1.25% negative. It's too much of an incentive for hedgers and funds and levered structures to make money. So they have to raise it at some point to prevent bubble popping. So it's not minus 1.25%, but is it 2%, which, and I'm talking real here, again, forgive me, just add or subtract 2% inflation whenever I'm talking about the real rate. So a 2% real rate means 4% Fed funds at the end of the journey. Is it 2%? Because that's what the Fed currently expects it to be close to where their destination is, and that was embedded in what they call the Taylor rule. You all know that. You know John Taylor from Stanford, 1991. The Taylor rule. The Fed and other central banks glommed onto it because it made a lot of sense, and it did make a lot of sense for a long time, and it worked until it didn't work, and it didn't work in 2006 and 2007, and we had a real rate that was so high, not mathematically, but so high that it broke the U.S. economy, the housing market, and the global economy. So it was this combination of a real rate and the levered structure globally, financially, housing, shadow banks, all dependent upon a low real rate. It was a real rate of only 1% in 2007 that broke the global financial markets that led to the Great Recession. A 1% real rate, because the Fed went to 5.25, inflation was 4.5. It was only 1% real, and they cracked the economy. So that alone, I guess, tells me that to return to a 2% real policy rate, which is what Taylor embeds and what the Fed believes in terms of their models, would be to dice with another Lehman-like disaster. This economy is still 350% of GDP, debt to GDP. It's still as levered, although to be fair, the leverage has shifted from households to the government, and it's safer there than on household balance sheets, but we're still a highly levered economy, and so are other global economies. And this 1% rate in 2007 actually broke the economy. You told me to wrap up. I thought it was short. Let me continue. What other evidence do we have as to what the real rate would be? Well, there's a study by the San Francisco Fed in 2001, when Janet Yellen was president there, by two gentlemen by the name of Laubach and Williams. And they did research on the real rate and how it changes and so on, and they've updated their model all the way till the end of 2013. Their information, that comes from the Fed, says that the real interest rate should be a minus 25 basis points, not 2%, which is what the market and Fed participants expect it to be. And other research as well. Rogoff and Reinhardt. I love Rogoff and Reinhardt. Talk about research. You can get lost there for weeks at a time, and not necessarily that it's right, but it's good research. And sometimes it's criticized, and sometimes it's wrong. But basically, what they showed was that since the last Great Depression in 1935, that real interest rates in the U.S. and the U.K. up until Volcker in '79 were a minus 25 basis points in the U.S. and a minus 1% for the UK. And so all of these examples say that in a levered economy, which is the critical element, which is what the Fed, in my mind, can't build into their model. This is a subjective Red Queen type of situation in which you don't know, you can't model. And so the Fed doesn't want to go there. They want to gradually think that maybe things might change gradually, but a 2% real rate is far too high in a levered economy. Okay, I get a few more minutes. I guess my point is that if the new neutral is closer to 0, the real one, which is what PIMCO expects, as opposed to 2, then asset prices, remember the connection to asset prices, that asset prices are less bubbly, that stocks at 16 to 17 times PEs can survive a mild bubble atmosphere with a 0% real rate. They can't survive a 2% real rate. We saw what happened in 2007. Same thing with credit spreads. Narrow, very narrow, artificially priced, very artificially priced. Avoid only if you think the real rate, the new neutral real rate, is going to be 2 or close to 2 as opposed to 0. At 0, things make sense, and it just depends upon whether the Fed and other central banks proceed along the expected path or whether they stop short, based upon what PIMCO thinks is their ultimate destination. So the new neutral is critical. Think about it yourselves. Is it 2? Is it 0? What should it be? And you can get into bonds with forward prices and forward yields, and you can get into stocks with PEs and all of that based upon what exactly that rate is going to be. And it influences volatility too. The lower the rate, the less volatile markets, and the VIX stays at 12, and Treasury volatility stays at 60% normalized, et cetera, et cetera. At 2%, you've got bear markets ahead. So hopefully the Fed knows what it's doing as it proceeds along. Is this a Pollyannish argument for a bull market? Not really, because we know yields are low, we know PEs are high, we know growth is being contained, and so most of the jazz has already been enjoyed. We expect, for instance, in the bond market, 3 to 4% returns going forward. We expect in the stock market 4 to 5% returns going forward, but we expect them to be relatively stable. Not that there won't be ups and downs and 10% corrections and all those types of things, but if the Fed and other central banks stay low, and the new neutral is closer to 0 than 2, then we've got a market in which you can at least take some measured risk and earn not a decent return, obviously not a decent return, but a return that is positive and relatively less volatile. And just to extend this quickly to the global marketplace, as we learned last week, other central banks have other new neutrals that they're trying to find. Abe in Japan is trying to find their new neutral situation, although the policy rate doesn't change, inflation does, and so the real rate changes. Carney in England and the UK probably will be the first central banker to, sort of like Christopher Columbus, to sail, got to get this right, not to sail west like Columbus did in order to find the east, but to sail up in order to find the measured returns of the new neutral. We think the UK will go first, but ultimately they have the same problem. What is the policy rate, and what prices in terms of equities and spreads should reflect that ultimate destination? For now, however, and just to wrap this up, investors, you got to make choices, right? You can't wait around, go home on the weekend and read Triumph of the Optimist and start thinking about what the new neutral should be. You got a portfolio, and you got to do something. And I think investors certainly have to be aware of certain things. They've got to be aware of quantitative easing and the end of quantitative easing in the United States. That disappears in November as a policy choice. Long-term Treasury bonds have feasted on almost 100% purchasing from the Fed over the past 3 or 4 years. It is hard to understand that every time the Treasury issues a 30-year bond, basically the next day, figuratively, the Fed buys it. And so when they stop that, and they're starting to, what happens to a 30-year Treasury bond when its buyer of first and last resort basically disappears? That will be an interesting situation and certainly influence the curve as well as the new neutral going forward. Take you back to the new neutral again as a close. To us, it's the dominant policy, the most important, the most wonderful, the biggest, the Manchurian candidate type of question for all investors going forward. And so it pays to at least have a sense as to where it might be. We think it's closer to 0 real than 2. We think that means that interest rate spreads, that credit, that volatility are probably better choices than duration, although duration isn't a bad choice, but would probably be third or fourth. And that a portfolio should be designed around expectations, informed by the Fed, of course, by question and answer sessions that we saw yesterday with Janet Yellen, but as well informed by your own subjective opinion as to why it would be low as opposed to high. For us, I cited the historical research. I cite again the commonsensical thought. In a highly levered economy, the new neutral has to be lower than it was historically. Taylor cannot be right. Sorry, Professor Taylor. I'll take this on as a challenge. Hopefully we'll both be around 5 years from now to pay each other off. But Taylor at 2 is wrong, and PIMCO and Bloomberg at 0%. Although I think Bloomberg didn't really say 0. They said new neutral. So I won't throw them into the pot. But in any case, that's the critical thing. And I think ultimately a portfolio, that this is a perfect portfolio for a PIMCO template, just to finish it off. Our template, again, remember, based upon bonds plus, based upon volatility sales, based upon rolling down the curve with intermediate structures. If the new neutral behaves itself is closer to 0 than 2, then the PIMCO template is in business. If it doesn't, then markets are more volatile, then curves flatten as inflation goes up, and duration is not a good bet. And so, again, in bond space, that's the bet, so to speak, in terms of what the new neutral is. Okay, I know we got questions and answers. I want to, before I wrap, thank Don. Thanks for putting up with my discussion of stamps at lunch. Thank you, Eric, for putting up with me for the past few months in terms of telling you how wonderful PIMCO is, with a little bit of a twist, so to speak, and a bias, which is normal, right? The new normal. And hopefully, with my sunglasses and my story about the Manchurian Candidate, I haven't put off too many of you. Maybe I'm not General George Patton. Maybe I'm just a 70-year-old version of Justin Bieber. I don't know. But thanks for listening to my late in life saga. We will follow the new neutral as we go forward. PIMCO will continue to employ its structural templates. This company is thriving in 2014. The total return fund may be just a little above its index, but everything else, global, diversified income, hedge, boy, you would want to own them, and of course I do. So thanks very much. I'll leave you, and after the session, again, my calling cards have an interesting twist that you may enjoy if I meet you up front. But have we got time, Don, for... No, we've got no time. I timed this at 30 minutes. Did you know that? And it's probably 45 or 50. That's the way it goes. Anyway, so that's my sign to do the patent sign-off, and thank you very much.